everybody, it's Daniel here from Infovest. Hope you're all doing well. So basically, Bank of Canada came out and they left the rates unchanged. They didn't hike, they didn't cut. They just basically paused and they gave basically their remarks on what they think about the economy going forward, their projections and so on, their ideas. So I'm going to go over this in this video. But basically, to sum up, Bank of Canada expects that inflation is on a higher path than what they expected. So demand pressures have eased more quickly than we forecasted in July, but overall inflation risk have increased since July. So even though you're seeing some demand pressure alleviate a bit, there's still that risk factor there, which is higher inflation. He says, we held policy rates steady because we want to allow time to cool off in the economy and worried that higher energy prices and persistence in underlying inflation are slowing progress. We made a lot of progress, but not there yet. We now expect oil prices to remain higher than we assumed in July. So that was the first remarks that came out from Macklem. So basically, to summarize, it was a hawkish pause in the sense that, you know, they see that inflation can still be a problem and it can be persistent. Although there's weakness in demand, you're seeing it, especially if you look at the housing sector, and you're seeing that that is a problem for many consumers who are facing higher inflation, higher rates, which is going into that demand side of things, which is why they suggested to pause until they have some sort of strong reason to then go back to hiking rates, right? And now they also came out during the press conference, and during the press conference, these are a couple of comments that they made. They said they talked about the exchange rate, well, actually not so important there, but basically, he said rate is part of how monetary policy works. Normally, large rate hikes boost the currency, but because the U.S. is also hiking, the currency has been relatively stable. So, okay, you have a stable currency there. We don't target the exchange rate, but we take it into account. We are seeing great evidence that higher rates are working. So whatever they've been doing and they've been tightening with, you can see that in the economy. But basically, the most important part is that he said we left the door open to higher interest rates if needed. So he did come out and say that, you know, there's still a possibility of higher rates if inflation continues to persist, if, you know, demand looks good, if, you know, jobs look good, if they continue to be strong, economy still seems strong, then guess what? They will hike more. If oil goes crazy, they may hike more, right? So it's basically saying, hey, we're pausing to see what is happening so far, especially in the last few months of this year. We want to see how the economy plays out, jobs, etc., especially when you hear Canadian banks like Scotiabank laying off a lot of employees. If you look at Scotiabank's stock, it's actually close to the COVID lows. So it's around November 2020 levels, but very close to the lows in 2020. So quite shocking that, you know, you're seeing, and that's not the only bank stock that's been under pressure. A lot of the Canadian banks have been selling off, but Scotiabank, which is one of the top banks in Canada, has been seeing their share price decline quite aggressively, right? So that might be a sign there that, you know, there is something happening in the economy that traders are worried about. So, you know, again, Macklem coming out, Bank of Canada coming out saying that we can see higher rates down the road, but we pause because we want to see what damage have been caused in the couple of months. If, you know, things look better and fine, then we will continue if needed, right? Then it says we need to see clear downward momentum in core inflation. So again, you're hearing the same rhetoric, the same tone from even the Fed saying that we need clear evidence, clear momentum, not just, oh, it's coming down and then we got a spike again and then we're down and then a spike. No. We need clear evidence. And what is that clear evidence? Is probably going to be that hard landing, which does bring possibly inflation lower. There could be certainly be 2 or 3 quarters of negative growth. So they're expecting negative growth. Also in the monetary policy report, they project that housing is going to see negative growth as well in the coming quarters. And they basically see a path to soft landing in Canada is narrower versus the US. So again, the whole comment about soft landing coming and this and that people were expecting last year, it seems like that is diminishing. And again, what does that lead to? It leads to hard landing. I mean, this is so funny because, again, on this channel many times I talk about it, that this is how the central banks start. They're obviously not going to come out and they're obviously not going to say and create panic saying, oh, be careful, sell everything, things are going to get worse. It's just so funny how we started in the start of 2022 saying that we're going to achieve inflation is going to come down. We're going to tighten things, and then we get to a point that first we started with no recession. It's going to be completely fine. Then to saying that, okay, we're going to get maybe a soft landing, to now saying things that now soft landing is not looking like it. It looks like we are going to see a recession. And then what comes next after that, right? If you see their path, they went from no recession, soft landing, to then what, right? To projecting a recession, and then what kind of recession as things continue to be tight, as the yields continue to go up. It's hard landing. And they don't need to tell you that, and they won't tell you that until it happens, right? Just look at history. It's just that simple, right? Sure, can I be wrong that there's no hard landing and it doesn't happen? Sure, definitely, right? Projecting this and trying to guess is all a probabilities game, right? But when you look at the history and the probabilities, if I were to make a bet, my bet is on the hard landing. My bet is on that, the central banks are trying to engineer this recession, this demand crunch, right? Even though they may not want to really kill they don't want to kill the economy completely, but they do want to soften the demand. They want to see that unemployment rate go up. However, when you get those levels to go up, the unemployment rate, when you get the demand crunch and so on, what happens always, again, going back to history, going back to, how things play out, when these numbers hit certain key levels, when you get, the same language that you've heard in 2006, 2007, to the lead up of 2008 crash, right? It just sounds so similar. So you're getting the same thing here. Going through again, it says, so Bank of Canada highlights the difference between U.S. and Canadian mortgage markets. Of course, I mean, people went crazy worldwide, sure, on low rates, but in Canada's a different scenario there. It's definitely way more levered, and there's a couple of stories. I'm not going to mention it here, but there are a couple of stories that I have seen and heard where and even witnessed where people were over leveraged and people were just buying like crazy, especially during the peak of the cycle where people were buying aggressively, and at crazy prices. It's just insane. So, and we're not talking about one property. Like, some of these people are buying 2, 3 properties, 4 properties. If you even see the construction out there too, a complete halt because the builders, I've been looking at the at some of these sites. People are it's tough for them to close on their property because the valuation has changed and they can't close on their property, and these builders are sitting on homes that are half built or not being closed on, right? So it's a very ugly scenario there, and there's definitely some differences that I would agree on. So other than that, Rogers basically says that relative to interest rates, we're not seeing the drop in housing prices we'd expect. So they're expecting drop in housing prices. So hello, housing doesn't always go up. They are telling you they expect housing prices to go down. We haven't seen it yet because yes, housing is lagging. It's 100% lagging. It takes its time. What's a leading indicator? The stock market's the leading indicator. And then housing takes its time, and it takes its time to also bottom. I talked about this in a previous video as well. I think the video is titled when does when do stocks bottom? I think I even talk about housing when it bottoms then as well. So you can check out that video. Also says Canada continues to suffer from lack of housing supply, of course, until maybe you get a spike in unemployment rate, people lose jobs, maybe they need to get rid of their investment properties, maybe regulations around Airbnb and so on, that may bring in more supply. We're paying very close attention to mortgage renewal cycle. Interesting. Of course, we'll look more at housing in November financial system review, right? So obviously, they are targeting housing in a way here. They don't want to blow it up, but you could tell they are targeting, and they're not here to save anyone, okay? They've got a mandate to bring inflation down. So they will go ahead and they will do it. Government spending doesn't look like it's been adding undue inflation pressure in the past year. I don't know if I really agree with that. All the spending that's happening, I do believe the fiscal side of things does have an effect. It's easier to get inflation down if governments and central banks are moving in the same direction. Now is not the time to discuss reductions in the overnight rate. So obviously they basically threw cold water on the idea of rate cuts. So shut up. There's no rate cuts coming until something really truly breaks. And says he wouldn't use the term stagflation, and the risks that oil could go a lot higher have increased, right? So of course geopolitical tensions, etc., etc. You get a war. There's issues with Iran, especially. You're gonna get disruption in the oil market, the supply, and so on. So overall, to summarize what is going on, let me just summarize real quick. Bank of Canada says that basically pauses rates and says that, hey, we're going to continue to watch the economy. The economy continues to do well. Inflation continues to move up higher. That's not within our mandate. We're going to do something about it. They still have left rate hikes on the table, but they pause. The key thing is they pause because they're assessing the damage. They want to know, okay, everything we've done so far, is there any damage? So they're going to review. They're going to review it in November. They're going to review it in December. And then they'll assess accordingly. What the markets are pricing in, especially in the U.S. markets, that the central banks are done, that the Fed is done, and you're not going to get more rate hikes. This is it. This is a pause, and then eventually you're going to get the rate cuts when something has been disturbed, credit event, etc., etc. So, anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.